Hello and welcome to another episode of Monday Markets. As always, you're brought to you by Woo. Links available in the description below. They have a volume-based trading competition going on at the moment. If you want to just trade and be eligible to win some prizes, there are more details in the description, so be sure to check that out. So, I'm going to try to keep this video very short because I'm sure you're being bombarded with content about how you missed everything, have fun staying poor, I can't believe you took profit, can't believe you sold, can't believe you shorted, all of this sort of typical engagement reel, grandstanding, bait, whatever. Now, instead of going through all the timeframes, I think I'll just outline what I think is most reasonable / most important in this particular instance. The first thing I want to make, or the first point I want to make rather, is that if you're looking for a dip, that should have one of two forms. The first is a shallow open interest wipe. At the moment, we haven't really had that. And open interest has generally been climbing, and most of the pullbacks have been from shorts getting liquidated as the market pushes higher. You know, sort of market pushes, they short, price consolidates, pushes up, and those shorts get liquidated. So you see a pop-up in liquidations and a drop in open interest. Fine. If you're looking for a sort of open interest oriented dip, you'd want price down and open interest down at the same time, and then you'd want long liquidations to be higher, and that's your argument for a flush. At the moment, the flushes have all been from overly eager sellers coming in, market not doing anything, popping up, they get carried out. So if you're looking for a shorter term, shallower pullback, ideally that would be commensurate with a decrease in open interest at the same time, and premiums would get stuffed. There are a lot of liquidations and but some spike or notable spike in long liquidations as well. So basically, to some extent, the inverse dynamic of what we've had recently, or just something a bit more meaningful on that side. So that's what the shallow pullback would look like. Alternatively, your other option is like a deeper pullback. Now, and that would require the market most likely to print some sort of 10% plus pullback day. What would those reasonable pullback levels be? Well, it's dealer's choice, really. I think there are three that make sense contextually if the market gives them to us. The first and the earliest candidate is the breakout level at 37K. So that's essentially the last consolidation that we had before this most recent leg up. Now, would it look bad and be technically scary if the market, puts in these strong 3-4 days and then just pulls all the way back to the consolidation? Yeah, it wouldn't be a great look. But you can't talk about wanting a pullback when the market looks strong and then just completely ignoring it when the market gives you what you wanted in the first place. So that's the earliest level from a high time frame, horizontal support resistance point of view, 37K. What is the next earliest pullback level if we start to eat shit? It is at 35K. It is that monthly area that we closed above. So then again, this would look quite bad that you had to close above, push up, and then if it were to push down into monthly support, that would be quite an ugly looking wick. But again, you wanted a pullback, you got one, so you better be ready to do business in that instance. And option 3 for a pullback, which isn't shallow, is all the way to 32K. The further we push away from there, the uglier that would look. But from a technical perspective, still somewhat salvageable because it's completely plausible for the market to wick, whatever happens, however it gets there, maybe from 50, maybe from 100K, whatever, it doesn't matter. Just purely setup wise for the market to wick 32K, which is weekly support, and then ultimately close above 35K, which is monthly support. So that would also make sense. And really, that's what we're left with in terms of options. So just to recap, if you want a pullback entry, if it's going to be on the shallow side, you want to see a flush, price down, open interest down, premiums get flattened, and long liquidations up. If you want a deeper pullback, that would have to be into daily, weekly, or monthly levels, and it would be significantly scarier than this, but also at least you're trading levels and not air. And your candidates for deeper pullbacks are 37K at the earliest for daily, 35K at the earliest for monthly, and 32K at the earliest for the weekly time frame. So these are your sort of technical pullback areas. As you can see, we're pretty fucking far away from that. So this on its own is one category. This is the pullback category. Shallow, we know to look for short-term participants to get nuked. Deeper, we know that we've got sort of in descending order from daily to weekly to monthly. Now, what if we forget this category and say, fuck a pullback, how do I get on board now, right? Now, before we address that, where do I think is potentially the worst area to get on board? It's not quite here yet. In order to answer this question, we must first answer another question, which is where is resistance? And even if the market's super strong, contextually speaking, where are you most likely to get hosed? To me, that area is between 44 and 46, which is the monthly range midpoint. Comes in at 46.8. If you want to just take a more generous view, you take this monthly cluster between 44 and 47-ish, and that gives you your contextual area of resistance. That is something and not nothing. If we view this area on the weekly time frame, it is also sort of rather self-evident. You have this cluster here, acted as support, acted as resistance, and then our industry went to zero. Even if you forget the left portion of this, it's just sort of around the area of the last lower high before the market collapsed entirely. So we know that as we start to approach it, perhaps as early as 41.8 to 43, as we sort of push into this area, you know that we're not in the middle of nowhere anymore, but rather we are at some weekly time frame levels that are important. So that's just the first thing to bear in mind. Now, going back to answering the question of if I want to get on board now, what do I do? I think reading my tweet on lower time frame sort of trend trading stuff is helpful. But since you're watching a video, it's probably best not to reference tweets. The most pertinent part of that thread is the following. Your best choices are 1, contextual levels, right? Contextual levels. 2, low time frame times 100. That's not leverage. That just means really low time frame. And 3 is trend. Now, what do I mean by all of these? So for contextual levels, I mean that if all of our supports are like down here, or realistically, this is like the earliest on the daily time frame. This is like the earliest version, and the rest are out of sight. But we want to be doing business around where the market is now. So how do we do that? We make reference to contextual levels. Now, what are those? It's Monday's range, so Monday's high and low. It is the daily open. It is the weekly open. It is previous day's high, previous day's low. It is previous week's high, previous week's low, and all those levels they're going to print no matter what, even if the market is far away from them. So that's your first port of call when it comes to finding levels. Second option, when I say low time frame times 100, I just mean that if you're mostly looking at monthly, weekly, daily, and you want to do business close to the market now, well, you can't, because we're not close to those levels now. So you have to make a compromise, and instead of going to your monthly, weekly, daily, as much as it pains me to say this, you really have to go to your 4 hour, 1 hour, 15 minute, and in some instances even 5 minutes. Now, the good thing is, not a lot changes. So the way you find your levels, the way you find your ranges, the way you look at your entry triggers, most of that is consistent between timeframes. So you just apply your regular ways of mapping and executing on the market. There are timeframe nuances, but fundamentally it is the same thing, and you just do it on lower time frames. So for example, if you were to look at all of this on the weekly, it just looks like big candles in the same direction. There's nothing going on. If you look at the same price action on the 15 minute, then you can start to see different little spikes, breakouts, support resistance flips, and what have you. So that's essentially what this point is getting at, that yes, I know that we're not at monthly levels and there haven't been any high time frame pullbacks, but that doesn't mean that technical trading goes out the window entirely. You just have to sort of constrain and compress your time frames. And the third point is trend. By that I mean you throw the technical horizontal baby out with the bathwater. You just get rid of the bathroom entirely, if we were to extend the analogy, and you say, fuck it, get me my moving averages. I want the 15, I want the 21, I want the 50, I want the 100, I want the 200. Give them to me on the 5 minute, 15 minute, 1 hour, and I'm just going to trend follow like a good little boy until I get wiped out, and then I'll trade the high time frame levels. And to be clear, both of these are fine, but there are trade-offs involved, right? So for example, let's say that you have absolutely no interest. You've got DonAlt monkly discipline, and your argument is, well, I don't want to do my low time frame stuff because it's noisy, and I don't want to do the trend stuff because I don't use it, so I'm going to just wait for the mega high time frame retests. And that's completely fine. And there is a world in which the market just continues to melt up, and because you were waiting, you get fuck all entry. And that feels bad, but that's the trade-off of that system. And of course, there is a trade-off associated with the opposite system, which is where you say, well, you know what, high time frame support resistance shit, completely useless, it's FUD, we're so far away, I'm just going to do low time frame trend following. And the way that would work is, you're following the trend on low time frames, and then, you're sort of buying here, it's going really well, and then you get your high time frame pullback. And as the high time frame pullback's happening, person A, who's trading the high time frame levels, he's like, oh, cool, this better push down and go deeper, I'm fine to wait for it and what have you. But because you're trading the sort of micro and more local trend, and you've been sort of trading it more aggressively, 2, 3, 1 to 5% away from the market, as this starts to happen, you're getting long signals from your low time frame trend following system, except it's printing you long signals in what ends up being a high time frame pullback. So ordinarily, 2 to 5% pullback into trend, you trade it, print, 2 to 5%, trade it, print, 2 to 5%, trade it, print, 20, 30%, you eat shit. So from a sizing perspective and a bankroll management perspective and a emotional sort of capital perspective, I would suggest that if you're going to abandon the high time frames and simply try to catch a piece of this and trade it for what it is, the two most important things are, one, be aware that 44 to 47 or whatever those levels are, and as we push into the mid-40s, that is a non-trivial area of high time frame resistance. And the second is that if you're going to be playing close to the market and playing those daily opens, weekly opens, previous days high low, weekly high low, all of this type of stuff, low time frame trend, moving averages, be aware in the back of your mind that at some point they will print a signal that makes you buy a 5% pullback that turns into a 20-30% pullback. As long as you know the trade-offs and you're comfortable handling them, I think you'll be absolutely fine. In the meantime, if we get better, if we get some levels or some consolidations or push into the higher time frame levels that we talked about, I'll have more to say. But for now, I will save you the circus of monthly, weekly, daily when we're like fucking 10, 20% away from those levels and give you something that's hopefully somewhat helpful, actionable, or even just pedagogically useful for now. I'm going to shut up. Woo gives us money. Thank you, Woo, for the money. There's a trading competition. Be sure to check it out. That's all from me. Hope you all have a wonderful week. And we'll see you for the newsletter tomorrow, Wednesday stream, where Don's going to tell us how good his life is while we're eating shit, trying to make it. And then Casual Friday is going to be a doozy, I'm sure. Thanks. Bye-bye.